On a Tuesday morning that looked like any other, while most of the financial world had its eyes fixed on stock tickers and quarterly earnings reports, a quiet announcement came out of Beijing that barely made a ripple in mainstream Western media. No breaking news alert, no emergency segment on cable television, just a short, technical statement, buried in financial filings and central bank disclosures, that a handful of economists, analysts, and hedge fund managers immediately understood as one of the most significant economic signals in years. And once you understand what that signal actually means, you'll understand why some of the smartest money in the world has been quietly repositioning itself ever since. For decades, the global financial system has run on one simple, largely unquestioned assumption. The United States dollar is the center of the world. It is the currency nations use to trade oil. It is the currency central banks around the world hold in reserve to back their own currencies. It is the currency that, when crises hit, investors around the globe flee to, because it has always been considered the safest, most stable, most trusted store of value on the planet. This isn't an accident. It's a system that was deliberately built after World War II, when the United States held the majority of the world's gold reserves and the strongest economy on Earth, and the rest of the world agreed to essentially anchor their financial systems to the dollar. For most of modern history, that arrangement has worked, and worked well, giving the United States what economists often call an exorbitant privilege: the ability to borrow more, spend more, and print more than almost any other nation, because the rest of the world simply kept demanding dollars regardless. But privileges like this are not permanent, and history has shown, repeatedly, that reserve currencies do not last forever. The Dutch guilder was once the world's dominant currency. So was the British pound. Both empires believed at their peak that their financial dominance was untouchable, permanent, simply the natural order of things. Both were wrong. And the signs that preceded their decline, rising debt, overextension, a slow erosion of trust from other nations, look remarkably similar to patterns some of the world's most respected economists are pointing to today. This is exactly the backdrop against which China's recent move needs to be understood. Over the past several years, and accelerating sharply in recent months, China has been quietly, methodically reducing its holdings of U.S. Treasury bonds, the debt instruments that fund the United States government, while simultaneously increasing its gold reserves at a pace not seen in decades. This is not a small technical adjustment. This is one of the largest economies on the planet, deliberately signaling that it no longer wants to hold as much of its national wealth in a currency it does not control, backed by a government whose debt levels it clearly views as increasingly unstable. And China is not acting alone. Central banks around the world, from Russia to India to several Gulf nations, have been following remarkably similar patterns, diversifying away from dollar-denominated assets and increasing gold purchases at the fastest pace recorded in modern financial history. In fact, central bank gold buying has hit record levels in recent years, a trend that accelerated dramatically after certain geopolitical events made clear to nations around the world just how easily dollar-based assets could be frozen, restricted, or weaponized in times of conflict. Once that realization spreads across enough governments, it becomes very difficult to reverse, because trust, once shaken at that scale, rarely returns quickly. This is precisely the kind of pattern Ray Dalio has spent years warning about in his own research on reserve currencies and the rise and fall of empires. According to his studies of financial history, no reserve currency has ever maintained its dominant status forever, and the transition away from a declining reserve currency typically follows a similar sequence: rising debt in the dominant nation, growing distrust from foreign creditors, a gradual shift by other countries toward alternative stores of value like gold, and eventually, a restructuring of the entire global monetary order. Dalio has been explicit that he believes the United States dollar is now showing early signs consistent with this exact pattern, and China's recent moves fit that framework almost perfectly. So what does this actually mean in practical terms? When a major economy like China sells off U.S. debt, it reduces demand for that debt, which historically pushes interest rates higher, since the U.S. government has to offer more attractive rates to attract other buyers to replace the ones who left. Higher interest rates mean higher borrowing costs across the entire economy, from mortgages to credit cards to business loans. At the same time, when major economies reduce their dollar holdings and increase gold instead, it signals to markets worldwide a gradual loss of confidence in the dollar as the ultimate safe haven, a psychological shift that, once it takes hold broadly enough, can become self-reinforcing. The more nations that move away from the dollar, the more urgent it becomes for other nations not to be the last ones holding it when confidence fully breaks. None of this happens overnight. Reserve currency transitions in history have typically unfolded over years, sometimes decades, not days or weeks. But the pace of the shift matters enormously, and what has alarmed many economists watching this closely is not that the shift is happening, but how quickly it appears to be accelerating compared to historical precedent. What used to be considered a slow, generational process now appears to be compressing into a much shorter window, driven by rising government debt levels, geopolitical tension, and a level of global monetary printing unlike anything seen outside of wartime economies. So what does this actually mean for someone watching this video today, sitting nowhere near Beijing, nowhere near Washington, just trying to protect what they've worked years, maybe decades, to build? It means paying close attention to a shift that history has seen before, and it means being honest with yourself about a question most people avoid until it's forced on them. What happens to your savings if the ground underneath the entire system starts to shift quietly, while everyone around you is still going about their day as if nothing has changed? Because that's exactly how it has happened, every single time, throughout history. Not with a single dramatic announcement that gives everyone equal warning and equal time to react. Not with sirens or headlines that scream the danger loudly enough for everyone to hear at once. It happens gradually, then suddenly, in the words used by economists to describe exactly this kind of transition. Slowly enough that most people dismiss the early signs as noise, as fear-mongering, as something that surely won't affect them personally. And then, all at once, when confidence breaks past a certain point, and what felt stable for years unravels faster than anyone believed possible. The people who come out ahead during these transitions are almost never the ones who panic at the last minute, scrambling when it's already too late to make thoughtful decisions. They are, without exception, the ones who understood the pattern early, who took the warning signs seriously while they were still just warning signs, and who made small, deliberate adjustments long before the headlines finally caught up to what had already been happening quietly in the background for months, sometimes years. This isn't about predicting an exact date. No one can do that with certainty, not Ray Dalio, not the world's top economists, not the central banks themselves. What matters is understanding the direction things are moving in, a world slowly, steadily shifting away from total dependence on a single currency, a single system, a single assumption of permanent stability, toward something far more uncertain. And for those who aren't paying attention, potentially far more painful. China's move is only one piece of a much larger puzzle unfolding in plain sight, but it is a piece that tells you, with real clarity, which direction some of the most powerful financial minds in the world are already quietly moving. The question this video leaves you with isn't whether this shift is happening. The evidence for that is already sitting in central bank filings and reserve reports, available for anyone willing to look. The real question is simpler, and far more uncomfortable. When the shift accelerates, whenever that happens, will you be someone who saw it coming, or someone finding out the hard way, right along with everyone else who assumed things would simply stay the same? If this kind of breakdown helped connect the dots for you, make sure you are subscribed to the Wealth Outline. This channel exists to track exactly these kinds of signals, the quiet moves made by major players long before they become front-page news everywhere else, so that when the next shift comes, you're not the last one to find out.